A blockbuster debut for the biggest IPO of the year. Cloud company Snowflake pricing its public offering at $120 a share, closing at $253 a share. That is a gain of 111%. But this isn't the first time we've seen a monster move in a public debut. Let's get to Bob Pisani with more on that. Bob.
Hello, Melissa. Good to see you. So you think Snowflake up over 100% on its first day is a big deal? Not really. There's been plenty of companies that have had first day pops bigger than that this year alone. And they include, just take a look here, biotech firm CureVac was up 240% on its first day of trading. Software as a service firm BigCommerce up 200%. Biotech firm Berkeley Light up nearly 200. Cloud company Encino up 196%. Insurance fintech firm Lemonade up 139%, all on their first day of trading. What they have in common is they're either tech or biotech firms. Are they outliers? Marginally, but the first day pop for IPOs this year is notably higher than usual. So the historic first day pop for an IPO is usually about 14%. That's historically, but not this year. The average first day pop in 2020 is 36%. What's going on? Well, it's not that the stocks are cheap. The multiples for a lot of tech stocks are historically high. People are willing to pay more for tech because there's just a higher degree of risk appetite out there. And if you're suddenly inspired to start buying these high-flying IPOs, I would be very cautious about this. Look after the first day. The post-first day returns of other high flyers is not encouraging. So there's been 11 IPOs this year that have popped more than 100% on the first day. They have averaged a minus 1% return from the first day close forward. So be very careful, Melissa, here. Big pop on the first day for some of these, but after that, very difficult to maintain continued momentum. Melissa, back to you.
Bob, thank you. Good to see you. Bob Pisani. And who's holding the bag in the aftermarket when these IPOs decline from the first day pop, Guy? Probably the retail investor. I mean, this has been the story of the IPO market since time began, though, and it continues today.
So you wonder why people get exercised when they see things like this. It's exactly that. I mean, I'll say it. I'm not a banker. I never was a banker, and I'm sure I'm going to upset some people by saying this, but there's no way to put it other than the fact that this was completely mispriced. Now, I'm sure the great bankers at J.P. Morgan and Goldman and whoever else, Citi, I think, was on this deal, and Allen and Company will say, no, we priced it right. You can't tell me that a company that has a $70 billion market cap, which opened at priced at 120 and tripled almost in price and had to be halted at some point today for price volatility, was priced right. And the people watching saying, how is this not a rigged game? I get it. It upsets me as well, but that's the way the business works, and that to me is problematic, Mel.
Why does it upset? I mean, what's the problem, Tim? They thought it was valued at something. Investors in the market thought it was something else. I mean, that's the way the markets work, right?
Well, again, though, it's terrible price discovery because you have some sense, and bankers want to price, and the companies want to price a deal that leaves some upside for investors. But to be clear, this is 3 times more, at least the guide from last week. And so the question really is, how can they be so far off in an environment where we know people are paying almost anything for growth, and that actually software and cloud-based services. But ultimately, I think the real question is, who gets access to this IPO? And the thing that's troubling is that this is not a fair game. And the allocation process is one that makes you sense that there are plenty of opportunities for people who did not deserve big allocations to get them. And I realize this is ultimately the dynamic of a company, first of all, that will say, I want a certain institutional investor base on my cap stack. And those are the people I want in my deal. I don't want certain people. Retail investors typically are not the group that companies want. There's a perception that they're going to be in there flipping those stocks faster. The reality is that there's a lot of hedge funds that probably flip this thing aggressively today. So again, to me, my issue is with the allocation process, and that it's not a fair process. Maybe it's not supposed to be. Ask the bankers that, because I think that's what this comes down to.
To be fair, there are some companies that actually say in the allocation that they want a certain amount to go to retail trading firms like a TD Ameritrade for those firms to then dole out to retail investors. But Grasso, I think Tim brings up a good point in terms of the average first day popping 36% this year. That really shows you what this market is these days, the search for growth, and what investors are willing to pay for that growth.
Yeah, and also you have to factor in we're in a different environment So the offering price is different than the opening price. And all of that is based on interactions with institutions, trying to figure out supply demand, while everyone is filming from a padcast or from an iPad in their home. So it's very different than last year. It's very different, the whole IPO process. Having said that, it really speaks to the reach for growth. So if you have the price action that we saw today, think about it. As Tim said, you want to have, if you're coming out as a public company, you want to put your stock in institutions' hands where they're less likely to flip out of that stock on the day of the IPO. And that's where the whole system might be flawed, but it's worked this way for a tremendous amount of time. And there's always going to be a problem with any system anywhere.